Hi everyone, happy Friday. Anne McCabe here with Curo Private Wealth. I hope you've had a great week so far. Today I want to talk about how our tax structure works in the US because it can be really confusing and there are so many misconceptions out there about how taxes are actually calculated. I was inspired to share more about how this works because I actually heard someone say they did not want to take a bonus because they were worried that bonus would push them into the next tax bracket. Take the bonus, and I'm going to explain why. The US operates on what's called a progressive tax system, meaning for everyone, regardless of how much money you make, the first X amount of dollars is taxed at a lower rate, and then it goes up the ladder, and the more income you make, the higher that percentage goes. These are divided into what are called tax brackets, and each bracket has a tax rate associated with it. So for example, if you are a single filer in 2024 and you make $100,000 of income, let's ignore for a moment deductions and credits, which we'll talk about in a little bit. The first $11,600 of income is taxed at the first and lowest tax bracket, which is 10%. Then income from $11,601 up to $47,150 is taxed at the next bracket, which is 12%, and so on. So if you make $100,000, you will pay about $17,000 in taxes, again, ignoring deductions and credits. This would put you in the 22% marginal bracket, which means any dollars above that $100,000 will be taxed at that 22% up until the next upper limit of income that would push you into the next bracket. But your effective rate, which is the average percentage that you actually paid in taxes, would be about 17%. And you calculate this by taking the amount of taxes you paid and dividing it by your overall income. Now, we can reduce our taxable income and liability by deductions and credits. Deductions lower our taxable income before taxes are calculated, whereas credits reduce our tax liability. So far, we've only been talking about ordinary income taxes, but capital gains taxes, for example, if you sell an investment and you had a gain in it, operate on a completely different tax structure just to keep things nice and complicated. The good news is capital gains rates are generally less than ordinary income taxes, assuming you held that investment for greater than 1 year. Then it would qualify as long-term capital gains. If you hold an investment for less than 1 year, it is taxed as ordinary income, so you do not get the lower tax bracket. Now, capital gains rates range from 0% up to 23.8%, depending upon your total income levels. Now, I have some bad news to share with you. While it always feels like tax rates are too high, historically, we are actually in a low tax rate environment. Back during World War II, believe it or not, the top federal income tax rate was 94%. You heard that correctly, 94%. And it's important to note that the Tax Cuts and Jobs Act, or TCJA, which was passed back in 2017, is set to expire the end of 2025 without further congressional action. So tax rates and brackets will likely be higher for most households beginning in 2026. As always, we recommend that you consult with your individual tax professional to understand how that may impact you and for further guidance. I hope this was helpful. If you have any questions, feel free to reach out. Remember, take that bonus. Have a great weekend, and I'll see you back here next week. Take care.